Let's talk more about that now with Jeff Kilburg. He's the founder and CEO of KKM Financial. What do you say, sir? Welcome.
Well, Kelly, kind of a surprise. Everyone was looking for a cut in rates, more hawkish, and we actually got more. If you think about that $40 billion they're going to start purchasing in just a couple of days, that's annualized $500 billion of new QE. So with a $6.5 trillion balance sheet, I think a lot of folks were surprised. That was the initial reaction, equities, but you're seeing a little bit of a shift here, and we're waiting for the presser. But I think this was much more dovish, and I think Fed Chairman Powell is keeping his job for another month because that's the one that we haven't talked about yet. And I think the long end of the curve is not pricing the fact that he may not be here in May of 2026 if President Trump has his way.
So right when the decision came out, you were standing right there, and you
Yes.
heard me say, this is the son of QE,
Yes.
or QE light. This to me, that's the headline. That's why stocks are moving. It's not the interest rate. No offense to any of our headlines or whatever. It's this diet QE
in the
with T-bills.
The sense of urgency. December 12th, they're starting to buy these bills. And that really kind of brings up the question.
I thought the economy was booming. Everything was great. Kelly's got a solid gold yacht. Everything's fine.
Yes, but they are clearly seeing something. Now, historically speaking, the Fed doesn't have the best track record. They talked about inflation being transitory, but nonetheless, they are seeing something. And this $500 billion annualized, it's $40 billion a month, folks. But this $40 billion a month that's starting in a couple of days, that is really surprising. I think that's going to move equities a lot higher because this is, I know we had one dissenter wanted 50 basis points. This is like a 35 basis point cut because it's another tool in their toolbox that is getting the same outcome. And it's going to increase the balance sheet, which is crazy that they just slowed the balance sheet down from draining and now they're kicking it off.
There's a lot to ponder, and I'm totally sympathetic to that. I think you're right about the market taking it that way, no question. But, they'll argue that this is, it's wonky. It's financial system plumbing. It's that the bank reserves level is getting too low because we're in an ample reserves, not a scarce reserves regime. And we saw this in 2019 with the repo flare, but they don't want it to happen again. So it's more of like a management tool, right, of the financial system than it is a tool of monetary policy. Now, maybe those are two sides of the same coin, but it seems as though the real question is whether they intend to do anything beyond kind of keeping up with the level of GDP that they're kind of doing now with the balance sheet, doing something more meaningful, more expansionary, and I think there's going to be a lot more questions about that. What is their intent now with the balance sheet? Is this just a temporary fix to a repo problem, or is it something more?
It feels like they brought the first aid kit out, and we haven't seen the wound yet. So maybe this job situation is going to decrease or get worse. But right now, the economy is strong. We're seeing profits. We just saw Q3 profits, Kelly. It doubled expectations. Yeah. And I know there's been an old saying, profits are the mother milk of the stock market and the economy. Maybe we update that and say, profits are the creatine of the stock market and economy. But we are seeing such strength. This is very surprising.